So you must understand that the movement of the market is actually to take out external range liquidity, return to fill inefficiency, and also to take out internal range liquidity. So you can see here from this bullish market condition, you can see we have price created the high, we have the pullback, and we have price created the low. So you would understand the multiplex nature of price, that price is actually fractal. You see structure in higher time frame, and then you can also see structure in lower time frame. So basically what we can see within this expansive move is actually the minor market structure formed within the expansive leg move. So this minor market structure forms the internal range liquidity. So what we're going to see is that price created this high as an external range liquidity, and then we have the pullback to the downside, price created the low. We have this minor pullback, push of price, minor pullback, push of price, and then you can see that the market took out the external range liquidity. So what you're going to be looking forward to see is the possibility of price also returning to take out an internal range liquidity. Price is going to feel all form of inefficiency within this expansive leg move, and then aim for the internal range liquidity. And this is that liquidity which we would call inducement or the sell side liquidity, with the possibility to actually mitigate any form of price inefficiency within this expansive leg move. So you can actually see that this is actually the high, this is the low, and then this is the entire impulsive leg move to the upside that took out the external range liquidity. For this higher high point to actually be valid, then this higher high point should actually pull back to the downside to take out internal range liquidity, which in this case is actually the sell side liquidity, which we refer to as the inducement. So basically the inducement is actually a price movement that is created before an ideal break in market structure, or actually after a break in market structure. So it's actually dependent on how the traders tends to identify these liquidity zones. So basically you must look forward to see that price will take out external range liquidity to validate the newly created high. You want to see that high also take out internal range liquidity. This helps you to actually mark out valid structure. So since this high actually took out this internal range liquidity, which is our inducement and also the sell side liquidity, so you can see that now this validates this high point as a higher high, and now price created a higher low because this is actually higher than this low. And then we have the impulsive leg move to the upside that took out this high point. So this is actually how to mark out invalid structure. So let's look at this example, which is actually an invalid market structure. What you can see is price created the high point, and then we have the drop of price to the downside, and then we have price created this low points. So you can see we have the impulsive leg move to the upside, because from this swing low points to this swing high point is actually the impulsive leg move. Let's not consider this particular price movement yet. So we have this low to this high as the impulsive leg move. But then you're going to identify within lower time frame, you're going to have structure within this expansive leg move. So now you can see that price created a pullback before the rate of this external range liquidity. So we have a valid break of structure where we continue to understand how to actually identify valid break in market structure. So you can see now we have price pullback to the downside, and then we have the impulsive leg move to the upside that took out this high points. But what you can see, price created this high points, but this is not a valid high points, because you can see that price did not return to take out internal range liquidity. So this is what mostly happened in the markets. So structure basically in the Forex market is all about liquidity. Price takes out external range liquidity, return to fill inefficiency, and also rate internal range liquidity. So you can see that this newly created high point did not fall to the downside to take out this internal sell side liquidity. So basically we do not really have a new high points. So indirectly this is trying to tell us that the entire impulsive leg move is from this low to this high point until we see price push back to the downside to take out this liquidity. Then we actually have this high point as a valid higher high point. So price yet have not created a valid high point, because why? We do not have this movement to the downside taking out this sell side liquidity. These inducements have not been rated. this internal range liquidity is still intact. So we want to see actually that, just the way we can see from this example, that a newly created high point will return to the downside to take out internal range liquidity and then push further to the upside. So this is how you want to be identifying valid institutional market structure. So now this is actually more of how to identify a bullish market structure. So once price gives the impulsive leg move, you are anticipating to see that the pullback will take out an internal range liquidity, which is actually now the inducement. That price movement that was created before an ideal breaking market structure or after the breaking market structure. It depends on how you can interpret that in the market chart, which we're going to look at an example. So now you can see that now we have the pullback to the downside, and now price took out this inducement, which is actually a sell side liquidity. So this validates this high point because this high point took out liquidity. Now we have price created the low point, and then price gave us the impulsive leg move that broke structure, took out the external range liquidity. So now we can see that now price created another high. This is a valid high because this returned to the downside and then took out the internal range liquidity and then mitigated a sponsorship zone within this impulsive leg move. And now you can see we have the push of price to the upside and we have breaking structure here. Now price created this high point. What validates this high point is the fact that this high point returned back and then took out internal range liquidity, which is the inducement. And then you can see price created the low. We have the impulsive move that took out the external range liquidity. Return of price took out internal range liquidity. So this is what you actually want to be seeing in the market. This is simple. This is just the simple means to actually mark out ideal institutional market structure. You want to look at price taking out external range liquidity, returning to fuel inefficiency, and to also take out internal range liquidity. So this is actually a bullish scenario on how to mark out structure. So what you can see is that now we have the bullish market structure shift. Now what you're going to see is this is the impulsive leg move. So we want to identify the inducement within this leg that price took out, and then we have the continuation. So we established this as the bullish market structure shift because we can see price created this high, and this high failed to continue to the downside to take out this low, and then we have price reversal. So now what you're going to see is that we have this push of price to the upside. This is a valid pullback. Why? Because what you're going to see is that this candle took out this bullish candle low points. The wick took out the low. So we have the pullback. Price gave us the impulsive leg. This is the entire impulsive leg. Why? Because we have the pullback. Price gave us this movement to the upside. What you're going to see is price created this bullish candle, but this is not a valid pullback because the pullback did not take out this bullish candle low points. Price continued to the upside. So our range is within this bullish candle. The pullback we are expecting is to see any pullback that will take out this bullish candle low points because it is actually the highest candle. But this is just an inside movement within the bullish candle. So this is not a valid pullback. So that is why you can see this is our entire impulsive move, and then we have the pullback because you can see this is the highest candle that price created, and then you can see that this candle went to the downside, took out this candle low point, and then we have this impulsive leg move to the upside. So now you can see now this is our inducement. Price return and then took out the inducement. Now we have price created a low point. Price gave us a high, created a low. So we are now expecting to see further bullish push of price to the upside, since this high point did not push to the downside to raid this low point. So now we can see that now price gave us this impulsive move that took out the external buy side liquidity. So we want to actually identify the inducement, the sell side liquidity for price to actually raid, and then we have the next impulsive move that will take out this high points. So price created this high. So we're going to look into the impulsive leg move to actually identify our inducement. So what you're going to see is price give us this push to the upside. We have the pullback. Price give us this push. Some will actually consider this as pullback. but this is not actually a valid pullback. Where's the highest candlestick that the market actually created? You can see this is the highest candle. So, and you can see that this movement is within the range of this candle. So we do not have a valid pullback. So we have movement that returns to the downside and take the low of this candle. So this is our impulsive move, the pullback, and then the impulsive move. So you can see this is where the pullback was established. Let's actually mark that out. You can see this is our impulsive move. This is the pullback. And then this is the impulsive move. Because this pullback is within this candle range. So it is not a valid pullback. So now this is where we have our pullback. And now what you're going to see is that the market returned and then took out this, because this swing low is our inducement. This is the pullback that was created before the break of the structure. So this is our inducement, and you can see the market returned and took out this sell side liquidity. And now we can see that now price created the impulsive move to the upside. Now what you're going to see is that now price came to the downside, took out the inducement, price pushed to the upside, but we do not have this movement reading this external range liquidity, price fell. So this is our ideal higher low points. So we can see that now price pushed to the upside and took out the external range liquidity. We have a valid break of structure. We have a valid higher high points, because this took out what's sell side liquidity, the inducement. So this is a valid higher high point. So meaning this is a valid break of structure, since this is a valid higher high points. So now we can see that now within this leg move, we have a push of price to the upside. This is not a pullback, because you can see that this movement is within this bullish candle. So it is an inside movement within this bullish candle. Price did not raid the low of this candle. Rather, this is where we can consider a pullback, because we can see this candle return to the downside and swept the low of this bearish candle. So now we have price broke the external range liquidity, broke structure, price pulled back. This is the highest candle that was created. Now you can see price return. This candle took out the low of this bearish candle. And then we have price again pushed to the upside and took out the high of the candle. So this is a valid pullback. So meaning this is our inducement. And you can see that price returned to the downside, took out the inducement. We have a valid higher high. Now price created a higher low point. And we can see that now price pushed to the upside. We have break of structure. So now we can see that now, where's the pullback? After the break of structure, this is the pullback. This is not our valid higher high points, because this did not return to take inducements created. So this becomes inducement because price pullback and then push to the upside. So this created a new high point. So we're expecting to see that this pullback will fall, raid this inducement so that we can validate this as a higher high points. But then price did not raid this. Price further pushed to the upside, took out this high. This is not a valid break of structure, because this is not our ideal structure high points. This is our ideal structure high points. So now we can see that now price created this high, and now this high returned to the downside, took out the inducements. Price further pushed to the downside, because you can see all form of inefficiency here have actually been mitigated by this movement. So definitely price is actually going to raid this sell side liquidity and this sell side liquidity, because we have inefficiency resting here. Price took out external range liquidity, return to take internal range liquidity, fill up inefficiency. And you can see price return filled up the inefficiency, and we have the impulsive move to the upside. So this is how you actually identify ideal institutional market structure. So in the coming episode, we're going to have chart replay, and then we'll be identifying this as we play the charts, so that you can actually see it from a real-time display of price movements. So this is an already established market structure that I'm using so that you can actually understand the concept behind identifying ideal institutional market structure. So I see you guys in the next episode.